The stock market often reflects the broader economy's growth. If you don't know how to engage with it, you may miss out on the benefits of economic expansion. For example, if you're not aware of how to invest in growing sectors or emerging technologies, you won't be able to capitalize on those opportunities. Thinking about retiring. Retirement planning often relies heavily on investments in stocks and bonds through things like pension funds, IRAs, or 401ks. Without understanding the stock market, it becomes challenging to make informed decisions about how to and grow your retirement savings, which could lead to not having enough money when you stop working. In short, not understanding the stock market can limit your financial growth, security, and ability to make informed decisions. Learning the basics can help you better navigate opportunities, avoid pitfalls, and build a more secure financial future. Manage. According to Trading Economics, the U.S. stock market has been progressively doing well since 1990, and it has not stopped growing. At the beginning of 2024, the main stock market in the U.S., called the U.S. 500, has gone up by 674 points. This means the value of the biggest companies in the stock market has increased by about 14%. And what does that mean for anyone? It means if you invested in one of those companies, your money will have gone up. So when the stock market is doing well, people think the whole economy is doing well, right? You'd think so. But just because the stock market is doing well doesn't mean everyone is benefiting. Wages haven't increased much in decades, and many families are still struggling, especially since the Great Recession of 2008. So, how could you benefit from the stock market? Well, how does the stock market work? Listen to this. Let's imagine Mike owns a small pizza shop. It's doing really well, and Mike wants to expand and open more locations around town. Right now, Mike's Pizza Shop is a private company, which means he owns it completely, and he's the one making all the decisions. Most businesses start this way because it's simpler to manage and gives the owner full control. But Mike wants to expand and open more shops around town. He goes to the bank for a loan, but they say it's too risky. So Mike has another idea. He can go public. This means anyone can buy a small part of his pizza shop, called a share, by investing in his business. Mike puts out an IPO, initial public offering, and people can now buy shares for, say, $1 each. Lisa, a local pizza lover, decides to buy some shares because she believes Mike's pizza shop is going to grow. With the money Lisa and others invest, Mike opens new pizza shops, which means more profits. Mike can now use some of those profits to open even more shops or give a bit of money back to his investors like Lisa. This is called a dividend. Now, Tom, who missed out on the IPO, hears about Mike's pizza shop doing great and wants to buy shares too. He offers to buy some of Lisa's shares for $2 each because he thinks the pizza shop will keep growing and the shares will be worth even more later on. That's basically how the stock market works. It's people buying and selling small parts of businesses based on what they think those businesses will be worth in the future. And this happens all around the world, thousands of times every second. So to benefit from the stock market, you have to buy a company share at a lower price and then sell them later when the price is higher. The difference between the price you bought it for and the price you sell it for is your profit. So say you're like Tom, who missed out on buying the pizza shop shares when it started offering. Where can you go to buy them now? You'd go to the stock market. Stock refers to all the shares a company has, and shares are the individual pieces of that company's stock. There are stock markets all over the world. There's the London Stock Exchange, LSE, Shanghai Stock Exchange, SSE, Frankfurt Stock Exchange, FSE, but the New York Stock Exchange is the biggest one. It's been around since 1792, when 24 guys met up to start trading because they wanted to create a system where they could buy and sell stocks in an organized way. Before this, buying and selling stock or trading was wild. People would meet wherever they could to make deals, and there were no set rules. The creation of the First Bank of the United States in 1791. Shares of the bank became extremely popular, and speculators, who were like early-day gamblers, went crazy trying to buy up as many shares as they could. People would literally chase the couriers delivering share certificates through the streets, hoping to buy some on the spot. Believe it or not, early trading in New York also involved pirates and privateers. These seafarers would return to port with goods captured from enemy ships, and they needed places to sell them. Some traders in New York made deals with these pirates, buying and selling their plundered goods. Let's just say it wasn't the kind of organized trading you'd find today. The New York Stock Exchange, where shares in big companies like IBM and GE are bought and sold. The NASDAQ is like the cool younger brother. It started in 1971, and instead of being a physical place, all the trading happens online. This is where tech companies like Apple and Facebook trade their shares. In the US, if you want to know how the stock market is doing, you look at both the New York Stock Exchange and NASDAQ. This is where indexes come in. They take the prices of lots of companies and turn them into one easy-to-read number. The S&P 500 tracks 500 of the biggest companies, while the Dow only tracks 30 of the most important ones. For example, in 2015, the Dow kicked out AT&T and added Apple. There are lots of companies that publicly trade and allow any member of the public buy their shares now. But back in the day, like 1900s, rich guys like Andrew Carnegie, Vanderbilt, and Rockefeller would buy the whole shares of a company and keep it to themselves, which not only made it super difficult for others to invest and get a slice of the pizza, but slow the company's growth. If they wanted to open a new branch, for example, they'd have to wait for Mr. Carnegie to cough up the money, which could take a while for him to raise the funds. Whereas if you had lots of people who could also afford the shares, then the company would have raised the money quicker than just Carnegie would be able to. So how do you actually buy shares today? You need an account with a broker, a company or platform that helps you buy and sell stocks. Here's how it works in 3 steps. Step 1, open a brokerage account. You sign up with an online broker like Robinhood, E-Trade, or Fidelity. These platforms allow regular people to buy and sell stocks. Step 2, fund your account. You put money into your account so you can use it to buy stocks. And finally, step 3, start trading. Once your account is set up, you can buy shares of companies you want to invest in. If you are just starting out, I highly recommend checking out stocks on Yahoo Finance and Google Finance just to get used to looking at stocks first and understanding their behavior, also because it's free to do. If you're interested, I will make a video about it. Leave a comment saying how to stock so that I can send you the link when that video is done. How do you pick stocks to invest in? Shouldn't you just choose the company that can make you the most money? Well, stocks are a little bit like betting. You don't know for sure how valuable a stock will be in the future. The current stock value can be affected by what others think. Take, for example, Johnson & Johnson, an American multinational pharmaceutical industry company. In 2019, the company faced lawsuits claiming that their baby powder contained asbestos, a harmful substance. When people heard about this, they stopped buying the product, and the company faced a lot of legal trouble. As a result, Johnson & Johnson's stock price dropped. When we say a stock price dropped, it's like during COVID when store owners increased the cost of toilet paper because lots of people wanted it, but the price dropped back to normal when less people needed it. So Johnson & Johnson stock price dropped either because people were selling their shares for cheap amounts or nobody wanted to buy the company's stock because they were worried the company would lose a lot of money from lawsuits and fewer sales. So even though the current stock value can be affected by what others think, John Maynard Keynes, Nobel Prize winner and one of the most influential economists of the 20th century, advises that you could use that to your advantage by buying stocks you think others will be interested in buying. He came up with this analogy, wonderfully named after himself, called the Keynesian Beauty Contest. In this beauty contest, the judges are rewarded for selecting the most popular faces among all judges, rather than those they may personally find the most attractive. If you are really good at Family Feud, the one hosted by Steve Harvey, you could be a Keynesian investor. Another way to choose stock to invest in is called value investing, which is practiced by Warren Buffett, billionaire, not a playboy philanthropist. Value investing is when you buy stocks that look like a good deal because they're cheaper than they should be. The idea is to buy low, wait until the stock's real value goes up, and then sell for a profit. It's like finding a great item on sale, knowing it's worth more than what you paid for it. He looks at the company's balance sheet, like a report card for businesses, looks at their profits, and checks if the company is run well. This is more time-consuming, but you can't argue with the result he's gotten from it. He did say that if you don't have time for that, you could buy an S&P 500 low-cost index fund. An index fund puts a little bit of your money in all companies in the index. If you want me to make a video on value investing, leave a comment saying, "More value investing." Does investing in the stock market have to be only about making money? After World War II, the stock market helped boost the American economy by providing companies with the funds they needed to grow, create jobs, and develop new products. This helped millions of Americans find work and build wealth through investments, contributing to the rise of the middle class. The stock market also fueled innovation and consumer spending, which further strengthened the economy and made U.S. businesses global leaders. At the end of the day, we all care about the future. Most people want companies to make money in a way that's good for everyone, not just for shareholders and CEOs, but for employees, customers, and the planet. So, investing wisely isn't just about making money. It's also about choosing companies that do good things for the world.